Now, the tremors from Europe, as he was just talking about, being felt all over the world, especially here in the United States. We're joined by the always outspoken Marc Faber. He's the editor and publisher of the Gloom, Boom, and Doom report. Marc, weigh in. Do you believe that Greece will have to exit the euro eventually?
Well, I think there is a very good chance that it will exit the euro, and I think it would have been desirable if the euro countries had kicked out Greece already 3 years ago. It would have saved a lot of agony rather than to bail it out, and as a result of the bailouts, the problem has become bigger and bigger and bigger.
So if it does have to exit, do you believe that the policymakers have what it takes to manage this exit properly, Marc?
Look, I think it would be much better for Greece and for actually the entire euro area if Greece were kicked out, Spain was kicked out, Italy out, and even France out. At the end, you just have Germany with the euro. That the other countries can have their own currencies and still trade and use the euro as an international currency.
So, Marc, let me just re-ask you that question that I heard earlier when I had asked earlier when you had said, you know, it looks like eventually Greece will have to exit the euro. Do you think the policymakers have what it takes to manage that exit properly?
Yes, you see, the bureaucrats in Brussels and the media, they're brainwashing everybody that if Greece exited the euro, it would be a disaster and so forth. But my view is the best would be actually to dissolve the whole eurozone, and that the countries would go back to their own currencies and still use the euro as an international currency. The way, say, you travel through Latin America with a dollar, you can pay anywhere you wish. And so that, in my view, would be the best. And then these countries that have financial difficulties, you just have to write off their debts and then make it difficult for them to access the capital market in future. Just to keep on bailing them out is going to increase the problem. It's not going to solve the problem.
Marc, how could you dissolve the eurozone and at the same time avoid an economic catastrophe?
Well, explain to me why there would be an economic catastrophe. Many countries had pegged currencies and then they gave up the peg to another currency, and it wasn't a catastrophe. It's, as I say, the public has been brainwashed that the breakup of the euro would be a complete disaster, when in fact it may actually be the solution.
But okay, let's just take one side of that. Let's say the Europeans dissolved the euro and allowed the countries to go back to their own currencies. And I don't want to get too far into an exercise in speculation, but you could literally have a race to the bottom among various countries to devalue their own currencies to stimulate growth. And when you have a race to the bottom, am I right about that?
Yes. I mean, well, first of all, you are aware, and your listeners also, that I do not have a high opinion of the US government. But the bureaucrats in Brussels make the government in the US look like an organization consisting of geniuses. The bureaucrats in Brussels are completely useless functionaries, and they want to maintain their power. They always talk about austerity being bad and so forth, but if you look at the government expenditures of the EU, in 2000 it was 44% of GDP. Since then it's grown by 76% under the influence of the Keynesian clowns, and now it is 49% of GDP. That is the problem of Europe. Too much government spending and lack of fiscal discipline. And the fiscal discipline, there is a fiscal pact under the Maastricht Treaty of deficits of less than 3%, but every country broke it, and the first one to break it was actually Germany.
Right. That's true. Marc, just hang on one second. I want to just have you listen to some comments from an earlier guest on an earlier program, Jonathan Golub from UBS Securities, about how investors might want to play what is going on in Europe.
the mistake that we've made every time that people have sold on some of this European stress is policymakers are just so unbelievably committed to not having worst case outcomes. Basically, if they can kick the can, they will, and investors can't underestimate that.
So he is saying that it may be a mistake to short the euro, let's say, or to sell out of Europe because investors are underestimating how committed policymakers are to keeping the eurozone together.
Well, I haven't talked about investments. I want to make this very clear. The investment markets may move in different directions than the economic reality, because if you print money, and that's why in the Bloomberg poll, Mr. Bernanke is viewed so favorably, because fund managers and analysts and strategists, all they're interested in is to have stocks going up so their earnings also increase and the bonus pool increases. But in reality, the economy can go downhill and the stocks can go up just because of money printing. And in Europe, the ECB has proven now that they're also very good money printers.
Mark, where would you then be exposed to, if you wanted to, exposed to in Europe?
Well, actually, usually when socialists come in or there is a crisis such as we have in Greece, it occurs usually near market lows. So I think if someone really wanted to take speculative positions, he should look at quality non-financial stocks in countries such as Spain, Italy, France, Greece, and so forth. I think a rebound is coming. The market on a short-term basis is oversold. But I'm just saying that if you look at the market action, first of all, we made a low, say on the S&P, last October at 1,074.
Right.
We went to 1422. The market is down from 1422 to less than 1360. And the whole world is screaming that we're in a bear market. This is a minor correction, but I think it may become a more serious correction as the technical picture of the market has deteriorated very badly, and as the S&P made a new high this year on April 2nd above the May 2nd high of last year, all the European markets are lower than they were a year ago.
Mark, I'm glad you're bringing it back to the U.S. and to the U.S. equity picture here. And do you believe, I mean, given in this money printing environment and what people are talking about with the Fed and more stimulus, is that what's going to put a floor on the S&P this year?
Yes, I think we had a rally that began in March 2009 at 666 on the S&P. We made an orthodox top a year ago on May 2nd, 2011 at 1,370. And then we made a new high on April 2nd of this year. But the new high was not confirmed by the majority of shares. And many shares are already down 20% or so. And every day there are some shares that are breaking down, or on good news they no longer go up, which is a bad sign. So I think that maybe we've seen the high for the year, unless you get a huge QE3, but a huge QE3, and that may not be forthcoming.
And Mark, you know, we seem to be hovering at these jobs claims numbers, these levels for the last several weeks, as Mike was saying. And overall, you know, we're generating about 150, 160,000 jobs. Is that the reason why you don't see QE3 coming from the Fed?
No, I think that QE3 will come, but it depends on asset markets. If the S&P dropped here another 100, 150 points, I think QE3 would definitely occur. But if the S&P bounces back and we are above 1400, I think the Fed will be essentially waiting to see how the economy develops. The economy in the US consists of different economies. Some of it is very strong. I was in Southern California. There, essentially, the economy is doing fine. In other places, it's not doing fine. So it's not universally bad, and compared to other countries, it's actually doing relatively well.
You warned, though, Mark, a few months ago when you were on our program that you thought, looking at earnings or ahead of the earnings, that we may see profit margins shrink, that the record profits we've seen from some of these companies may be no more. You still feel that way after having gone through part of this earnings season?
Yes, I think that if you look at the statements by corporations, it's very clear. And earlier on you had a commentator who said the exports to Europe from the US are irrelevant. That I agree. But what is relevant are the businesses of American corporations in Europe and the earnings they derive from these businesses. And that is definitely slowing down. So the revenue growth is slowing down. And in my view, you will have more and more corporations that report earnings that are actually good, but they don't exceed expectations, and then the share price.
Bottom line, though, Mark.
The bottom line is, I think the market will have difficulties to move up strongly unless we have a massive QE3. And if it moves here and makes a high above 1422, the second half of the year could witness a crash.
A crash? Okay.
A crash, yes, like in '87.
Because exactly why, Mark?
Because the market would become technically very weak. I would expect, say, the market making a new high. If it happens, it would be a new high with very few stocks pushing up, and the majority of stocks has already rolled over. And the earnings outlook is not particularly good because most economies in the world are slowing down. People focus on Greece. Greece is completely irrelevant. What is relevant are two countries, China and India, 2.5 billion people combined. They are a huge market for goods, and these economies are slowing down massively at the present time.
Okay, Mark, I'm going to have to leave it.